Welcome to the Real Estate Investors Weekender Podcast. This podcast is brought to you by the award-winning editorial staff at NREIOnline.com. Let's jump right into this week's top news, features, and blog posts.
Hello and welcome to the NREI Weekender with your host, David Bodamer. How are you, David?
I am doing all right. How are you this week?
Doing fantastic. I got some notes in front of me. You were kind enough to send me, and it looks like we got about 4 or 5 stories somewhere around there to go through.
Yep. I'm going to highlight another 4 pieces for the week. I think this is an interesting week, too, since we do have some of those macroeconomic backdrop of, the Fed recently having lowered rates and now the yield curve inverted. So that's been a nightmare for trading, as we've seen this week. So I guess I think that's like sort of an interesting backdrop then for like, all right, our industry tends to be a bit of a laggard when it comes to things happening in the broader economy. So I think that's where where we're situated with this stuff this week is, I think, also in the face of what's going on in the bigger economic news.
All right. Where are we starting?
So, with that in mind, because this first one is very good news. So that's, so it is about, it's based on a report from CBRE where the U.S. office market has reached its lowest. The office vacancy rate is at its lowest point now in 18 years.
Wow.
According to their numbers, in the second quarter, 17.1 million square feet got absorbed, bringing the year-to-date total to almost 67 million square feet, and that dropped the national vacancy rate to 12.2%.
Wow. I mean, so that's good. It means there's a lot more businesses.
Yeah, and I think I actually found it really interesting that we're reaching that level because of some of the trends that we've talked about in the past around co-working and around office tenants actually, in some cases, reducing the amount of space that they're leasing. So even when with that also, there's been the rise in a lot more people work from home or work from co-working spaces. So even given those pressures on the market, on the office market, the fact that the office vacancy rate is this good actually speaks to how strong demand actually has been from office tenants. So I think it's actually particularly remarkable because it's been fueled, by the economic cycle we've had, but it's also cutting against some things that actually you would think would be putting some pressure on to drive vacancies upward.
Gotcha. Now, does the report itself talk about who is trending as far as who has the lowest percentage, who has the highest percentage? What areas of the country are doing really well compared to others?
It does break down. If you go to their original report, it goes through all the markets. But the ones that we point out that have the lowest vacancy right now include a lot of these tech markets like San Francisco, which is at 4.8%, San Jose at 5.9%, Oakland at 7.8%, and then in on the other side of the country, Charlotte, North Carolina is at 6%. So there are some markets particular, and I think where the story is partially driven by tech, which is which I think is showing the strongest demand for office space. So the markets that have a high concentration of tech companies are not coincidentally the ones that are performing the best right now.
Mm-hmm. In our last podcast, or the last stories from last week, I remember you talked a little bit about a few of the companies that were struggling because of increasing rents and cost to do business. Is this trend of these offices filling up, does that affect the rent or lease rates that are going on in these different cities?
Yeah, definitely when you have lower vacancy rates, then that's going to help drive rents up. So overall asking rates rose 5.1% from a year ago.
Wow.
To $34.28 per square foot. So that, in general, office, low vacancy rates help drive rising rents.
Yeah, absolutely. I don't know how good that is for business though, because those
Well, for
businesses
tenants,
struggled. Yeah, for tenants, I don't think they like that.
No, not necessarily, unless they're then I think unless they're a growing tenant, and it's just. And as long as like the rental increase maybe isn't escalating too fast, that's a cost you can bear. But again, like some of those other trends, it's like maybe you're doing a little bit less square footage per person. So maybe you're getting more bang for your buck out of the square footage. That can also then offset those costs. Like I know that's what my company did when we moved from our previous office to this office. Going to the office plans, getting rid of a lot of the storage space. So there's just a lot fewer square foot per person, a lot more people per floor,
Gotcha. That makes sense. Absolutely.
Yeah. So maybe the rents, on a square foot basis, the rent may be going up, but if you're taking less space, maybe your overall real estate costs are not going up as much.
Yeah. What else do we need to know from this story?
So it's in terms of just their overall office market outlook, new office completions, the number of new office buildings that opened in the second quarter rose to 14.7 million square feet, since the largest amount of new space to hit the market in one quarter since 2009. So that's over a decade ago. And there's another 111 million square feet that's now under construction. So there's a lot of stuff in the pipeline, and a lot of stuff that's coming online, which I then again, given that there's new space, a pretty robust amount of construction, the fact that the vacancy rate went down just shows you how strong demand was. Now, I think that this is kind of why then I had the whole preface before the story, which is okay, if some of these headwinds that are signaling, maybe a recession coming, then this could all kind of, that's always the recipe when the market, the real estate market, turns on a dime all of a sudden, where you got a lot of demand, you got a healthy business climate, you got businesses that are opening or expanding, driving construction, driving demand. Suddenly you put a brake on that, maybe that then suddenly the demand may go away faster than the supply can adjust, because if these projects are under construction right now or slated to come online in 6 months or 12 months, suddenly we have headwinds. Then you get into that classic scenarios that we've seen in the past, where suddenly you've got empty office buildings opening, existing office buildings losing tenants, and then you got brand new buildings opening, and suddenly the vacancy rate skyrockets, and that's the recipe for a down cycle.
Yeah.
So, I mean, that's, I think, the risk, but for now, the activity that is occurring and continue, but none of that's occurring yet. So I think, for now, we're in a good place. These vacancy rates are low. Businesses are doing all right and driving that demand.
For now, it's good news. And if it turns, we'll have that update too.
Yeah, exactly.
All right. What's the next story?
So switching gears considerably, another interesting piece this week was based on a report from Apartment Guide, which found that 54% of young people who are about to graduate from college plan to move back home to live with their parents. So the ramifications of that are that typically, that's a pretty high. I think historically, that's a pretty high level. And according to the managing director of Apartment Guide, Brian Carberry, who we interviewed for the story, the way he put it was, as recently as a few years ago, it was almost embarrassing to move back home with your parents. We're seeing that as an increasingly viable option for college graduates. So this may have been, I certainly, I mean, I know when I graduated from college, it was not a goal to go back home. It was, get on your feet, maybe get a roommate or whatever, but at least just try to, get going. Now it seems like it's increasingly acceptable not to do that. So I think that's ultimately that's the importance of this trend is for the apartment market, where, historically new college graduates are going and becoming new apartment renters. So that's part of what fuels demand in the apartment sector. It's like, you think about the typical cycle. You graduate college, you try to get your first job, you get your first apartment, either a small place by yourself or a roommate situation. And then, down the line, you become a home buyer. I mean, that's at least the American trajectory. This is now, I think, ultimately what the story is pointing out is that this is creating a lag in that process where, an increasing amount of people are graduating college, going back home, staying there for a while, trying to get on their feet, even if they have a job, but at least living at home, and kind of delaying this whole process of becoming renters, forming households, and that whole cycle just gets kicked down the road a little bit.
Yeah, I think it's a wise decision if the housing market is at a point where it's too expensive, which I think we've kind of talked about that. Even renting. I'm curious if this is actually hurting the apartments. In realistically, is it hurting them by people teaming up, becoming roommates instead of having their own place each? Is that really affecting them? All these, the graduates moving back home. As a parent, I would welcome my children to do that with a plan, right? I mean, that's you do have parents that are just going to say, "Oh, come back and I'll take care of you." Oh, that's terrible. Okay, no, they're adults. Don't take care of them. Set up rules, boundaries, expectations, so they can be successful. Be there a couple of years, and then maybe save up some money, like you were saying, and setting up a household differently. But do you think is this truly affecting the apartments at this point? I don't see apartment prices dropping because of lack of tenants.
No, I think maybe what it speaks to is just the question of affordability in the multifamily sector and the apartment sector. I mean, apartments are the apartment sector is healthy. Multifamily is always healthy. There's always a lot of demand, but the rent to income ratio can get pretty high in some places where it just literally might not be possible, even if someone wanted to rent a place by themselves.
Yeah.
So, and then again, I think, the point that you're making then makes sense, which is, all right, what's going to be the decision that makes the most sense for an individual trying to get going? Like, do you want to pay 50% of your income in rent and struggle for a while, or do you save some money at home, live there for a while, have a plan to, maybe try to get some better income and then be able to afford something in a more healthy kind of ratio, or choose the option of doing the roommate situation. So there was another report that we looked at that I think kind of pointed out a few of these trends. It was from RealPage. So they found that basically 26% of all renters are people in their 20s or early 30s who live by themselves. So that's about a quarter. And they kind of call these people starting out singles. They have a median household income of about $36,000, and most of them will rent units that average about 785 square feet. So that's one chunk of the market. And for them, the median rent to income ratio is probably about 30%. Another fifth of these households are what RealPage calls roommates by necessity. Their median age is 28, with a median household income of $78,000 per year. And as Greg Willett, who is the chief economist with RealPage, told us, basically takes two folks from the starting out singles group and combine them into a two-person household. And then what you get is what then the roommates by necessity household. So rather than maybe taking a smaller place and having that ratio of 29% rent to income, by teaming up, each person's rent to income ratio goes down to 20%.
Oh, so that's a big deal.
It's a better. Seems like a better for an individual to do that.
Yeah, I think so too. Obviously, 9% difference. That can make a big difference in somebody's lifestyle.
Yeah, absolutely. I think it's pretty big chunk of change for the course of the year.
David, I like to think long term. I'm a kind of a behaviorist by nature, to kind of see what happens because A happens, then B happens because A did, or A and B happened, then C is the result. So I'm really curious about this future of jobs, period, right? People going into college now, looking at these kind of statistics, whether they see them or they just know of friends or their friend's older brother and sister who are moving back with mom and dad because they've graduated. and thinking, I really don't want to do that. So I want to choose a different career because I want to make more money so I don't have to do that. Right. So that's one of my concerns is less teachers, less social workers, less policemen, firemen. While they make a decent wage, it certainly isn't necessarily a strong enough wage to be able to maintain your own household or not have to move back in with mom and dad or whatever. I hate to lose good people in those types of careers based on this kind of information. You know what I mean? So I know we don't have a study on that, but maybe in a few years, you and I'll be talking about that.
Yeah, I think that does touch on a real concern that's in the industry, and just that if average rents are so high, or that the average median income to rent ratio gets too high, then we have an affordable housing crisis. So I think there are some people that are pushing either they call it affordable housing or workforce housing, because I think sometimes affordable housing gets, for whatever reason, gets a negative connotation associated with it. So I think that there are people that are trying to, developers that are trying to cater to create supply that would be more affordable, so that, because the situation that you could have is that to have the kind of jobs you're talking about, but then you can't actually afford to live in the place where you want to do that.
Yeah, exactly. That's a huge problem.
So it's either you have those kind of jobs and you have to then live too far away. So it's the whole idea of creating an affordable housing stock close to where the demand for those kind of jobs would be, to make those kind of career choices achievable.
Yeah, exactly.
So I think those are I think those are definitely issues. Again, it's we've gotten outside the scope of this story, but I think it does connect to it because of what the dynamic that they're getting at. But I think we do have some. We will have we have written about that question before, and I'm sure we will again. So I think in a future podcast we can kind of center a discussion around it.
Yeah, that'd be great. All right, what's our next story we're covering?
So switching to another business entirely, we're going back to retail, which we talked a lot about last week. This week we had a chance to interview the CEO of PREIT, who is one of the major regional mall REITs in the country. And it was a good chance to kind of check in on some, hear from a top executive on some of the trends and challenges in the retail space, and find out how they've been dealing with them over the past, couple months and years. So they're primarily based in, PREIT stands for Pennsylvania REIT. They're based in Philadelphia. So a lot of their properties are in the mid-Atlantic. Historically, they had kind of a collection of, going back, over 10, 20 years, they've had a collection of some top class A malls, and some some a little bit lower, A minus, B plus class B malls. In recent years, they've got, been able to sell some of their weaker properties and kind of really focus on their highest quality assets. So it was kind of and they've done some redevelopment work, because some of their properties, been around for decades. So it was, so it was just a good chance to talk to get a sense of, what they're seeing in the mall space, and then how they've specifically dealt with some of the challenges. So what he told us, we asked him about, how they've been dealing with the store closures and bankruptcies that have been hitting the sector. And like I said, they sold off 40% of their portfolio between 2012 and 2018. They also have been tried to be pretty aggressive in taking back for their malls where they maybe had a Sears or another weaker department store. In some cases, they moved to take that lease back from the department store even before they made a decision to close. So that way they could focus on re-merchandising their centers. One of the more interesting stats about their portfolio that he mentioned was that, up from a few years ago, about, if you looked at one of their malls, it was probably about 70% apparel retailers, and including, I think, the percentage of department store business that would be on apparel. Now, it's down. Apparel is down to 40% of its portfolio, and instead they've grown a big chunk of health and fitness tenants. Now, 10% of their portfolio includes those kind of tenants, and 25% is now devoted to dining and entertainment. So they've kind of gotten a much more balanced portfolio, which is not so contingent on just selling apparel.
Yeah, that's a pretty big drop, 30%.
Yeah, I was actually surprised that it was that much of a transformation, and I think that seems like it's been a pretty big focus and pretty successful if they've been able to take some of those. Take some of the bigger department store spaces and carve them up, or get like a big alternative tenant, and then also do a fair amount of inline releasing.
Yeah, I mean, we could see that 40% go up if they let those stores come in that are renting clothes, right?
Right.
Okay, I'm just kidding. We don't need to go back to that story every time, but that still bothers me, David.
Yeah,
clothing, yoga pant rental. I just don't. Anyway, yeah. So wow, I mean, still that is a good sized drop. But so the entertainment that's interesting to me. Did they differentiate between what type of entertainment?
I think that includes theaters. For example. As well as like Dave and Buster's, or other similar concepts of dining, which has maybe that kind of like arcade component to it.
Got it.
So with that, I think they also mentioned that their portfolio is now 94% occupied, which is a pretty nice level.
That sounds pretty good. Yeah.
Yeah. And their comparable, their comparable store sales figures. So, went from $340 a square foot in 2012 up to $530 a square foot now. So that's also like a $190 per square foot growth over the past 7 years. So that's a pretty nice pace of growth.
That's sizable.
Yeah, and that's same store sales. So that's our comparable store sales. So that's the same tenants or the same space is generating more is generating more sales, not necessarily that they've just added a bunch of other things.
Gotcha.
One other, I think we've also had the trend that we've talked about around the increasing blurring the lines between online and in-person sales, or like the idea that you may buy something online and pick it up in a store, or or buy or have something delivered and maybe exchange it at a store. So like the transactions may be occurring both online and in the real world at the same time. So this has created an issue around how leases might be structured, and it was interesting to hear his thoughts on that, because historically the way that retail leases might be structured is that there's this thing called percentage rent, where if the retailer in question, hits a certain volume of, like, they pay a flat rent that's agreed to, and some fees that are agreed to, but then there's like this percentage rent component, which is once a tenant exceeds a certain threshold of sales, then they start paying a percentage of the additional sales as additional rent to the landlord, and so this creates both an incentive for the landlord to help make that tenant more successul by doing what they can, by having other good a strong center that's driving people, helping boost the retailer sales, and they help get a cut of that. So it's supposed to be like a model of a mutually beneficial model. But now, if the sale took place, if somebody made the order on their phone and picked it up in the mall, how do you count that sale?
Yeah, exactly.
So that's the question that's created, is like, so how do we actually now we don't even know how to calculate the amount of sale, like necessarily how to calculate the volume of sales that are taking place at the retailer because of the way the lines are blurred. So I think what he said is that maybe what they're going to look at is having less of the rent based on this percentage rent idea, and instead move to a more guaranteed or a minimum rent model, just to kind of like flatline the rents, maybe raise the rents if if the store is productive, but not be so contingent on this thing that's going to be much harder to figure out.
Gotcha. Yeah. That sounds like a lot of research.
Yeah. It just and who knows how much more that kind of stuff is going to continue to evolve.
All right. Anything else we need from this story?
I think I don't want to go too much deeper into it. I think he had a lot of interesting stuff to say about some individual retailers and about just overall trends. So I think those were some of my takeaways. But I think people should actually, if they should go and read the full interview on the site if they can.
Gotcha.
So then, wanted to talk about the last piece, one more piece in a little bit of detail for the week, and then move on. It's been a while since we tend to, from time to time, we do some galleries based on some data we get from different research reports or people in the industry. So we had one this week that was based on information from move.org with the cities with the lowest and highest living costs. So I thought that was interesting. So the gallery includes the 5 most expensive and the 10 most affordable cities for cost of living. So some of the, not surprisingly, the most expensive are dominated by major metros in California and in New York. It was New York City, San Fran, San Jose, Oakland, and then Boston in number 5. For example, the average rents for a 1-bedroom apartment in all these cities, Boston's is over $2,400 a square foot.
Holy cow!
I mean, not per square foot, per month. $2,400 per month.
$2,400 a square foot, dude. Yeah, somebody's making money on the side somehow.
Yes, that would be very very extreme.
Yeah.
But $2,400 in Boston.
Still per month is extreme. Holy cow!
For 1 bedroom. Yeah. $2,500 over $2,500 in San Jose. Over $3,100 in New York, and almost $3,400 a month in San Francisco. And then the report also included average cost of things like utilities, monthly food costs, gas, and internet to come at an overall figure of what is the the living costs here. So at San Francisco, when you're all in on just those 5 things: rent, utilities, food, gas, internet, you're over $4,200 a month.
No wonder people are moving back with their parents.
Exactly. So
come on,
bring it all back home.
That's just the rent for the 1 bedroom is double the mortgage on my house, which is 2,400 square feet.
There you go. I know. Yeah,
that's insane. Okay,
but on the complete flip side, the cities on the low end dominated pretty much by predominantly southeast and southwest. So going from 10 to 1 in terms of the lowest living costs, we had Mesa, Arizona, Albuquerque, Lexington, Kentucky, Memphis, Tennessee, Tulsa, Oklahoma, Louisville, Kentucky, Wichita, Kansas, Toledo, Ohio, Lincoln, Nebraska, and then the most affordable market in the country is actually El Paso.
Oh, wow.
Yeah.
So
rent there for a single bedroom is averages $658 a month. And then when you add in all the utilities, food, gas, internet, you're at just under $1,200 a month.
Wow.
So that's about not quite 1/4, somewhere between 1/4 and 1/3 of the cost of a month in San Francisco.
Yeah, that's a big difference.
Yeah. So anyway, we have the gallery, and we also have a link to that full report, which actually includes the cost for 75 cities, and also it's even looking at the full report, you kind of could see where a whole bunch of other cities fit in between those tops and the bottoms.
Yeah.
So yeah, those are some of the main pieces for the week. I also did a busy week, so there's a couple other headlines that I think if people want to go to the site and check out, if they want to go to NREIonline.com, we also had headlines this week about what co-working operators are doing and how they're expanding in the Southeast. We had a piece about how foreign commercial real estate investors are hedging their costs and how that's benefiting the way that they're how that's a benefit to how they're investing in the U.S. right now. And then lastly, a piece on the hotel sector and just what may be happening with rents there.
Yeah, interesting. All right, people can go check that out. David, thank you so much for all your time this week.
Thank you, and thank you to the listeners for tuning in.
Absolutely, and thank you for listening to the NREI Weekender with your host, David Bodamer. If you have not subscribed to the podcast yet, please click the subscribe now button below. This way, when David comes out with a new podcast, it'll show up directly on your listening device. Again, thanks for listening today. For everyone at the NREI Weekender, this is Aric Johnson inviting you back next week for all the news that matters to you. And we'll see you soon.
Click the subscribe button below to be notified when new episodes become available. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of NREI Informa. The content has been made available for informational and educational purposes only.